All right, everybody. Jimmy Vreeland from Joint Ops Properties back with Ryan Lee from Atlas Wealth Solutions. We're going to do a quick YouTube video on an interesting article I came across last week. The main thing when we've been talking about these whole life policies, the main objection we get is that it's too good to be true, and then why isn't everybody else doing this? And so when we do see examples of someone else doing this, especially a highly sophisticated, highly paid person in the media, we're going to bring it to your attention.
Okay, awesome. Yeah, Jimmy, I appreciate you bringing this article out. This is really interesting because, a lot of times I think we get financial information from people who are doing the exact opposite from what they tell us to do. It's do what I say, not what I do. And this is a perfect example of this, right? So Jim Harbaugh, interesting individual, right? He went to coach, left the 49ers, went to coach Michigan last year. And as part of his compensation package, Jim Harbaugh is getting increased compensation in the form of a life insurance loan. So what we thought we'd do is we're going to break this down, and we're going to talk about why Jim Harbaugh, number one, would want compensation in the form of a life insurance loan, and number two, why the University of Michigan would agree to such a deal there. So who is someone winning in this circumstance? Is someone losing? So we're going to talk a little bit about that and kind of break this down a little bit. But
this goes into my theory that when you get paid as a W-2 employee, you just have a tax target on your back. It's the least sophisticated way to get paid. It's the least efficient way to get paid.
You got it, right? And that's going to be point number one, is why use life insurance. And you mentioned it's the least efficient way to get paid. The reason for that, Jimmy, is the tax code. It's written in such a way to tell us what we should do if we want to keep more of our money, right? The first part of the tax code, 9 pages of the tax code is written for W-2 employees because, to your point, Jimmy, there's no way out. You go to work, you get your money, and before it ever hits your bank account, your taxes are skimmed right off the top, right? If we use
for the
tools,
class, they're the easiest targets.
Easiest targets, you got it. So let's talk a little bit about these numbers. So Jim Harbaugh is getting, he went from $5 million in salary to $9 million in salary in 2016, but the additional $4 is coming as a loan from the University of Michigan, of which the loan will be used to fund a life insurance policy. So Jimmy, what kind of life insurance? We haven't seen this policy, but we know from this article what type of policy it is. Most people, when they buy life insurance, they buy it for a death benefit. But if you know what you're doing, you can actually use life insurance as one of the most unique financial tools out there. What are some of the aspects that are involved likely in this life insurance policy?
He is going to take that cash, and he is going to not pay income taxes on it. He is then going to fund a policy. I think the big bridge people have to get over with this whole life insurance policy is like the death benefit. Who cares? It's not about the death benefit. It's a more efficient system and a better place to put your money than a bank. It has several other advantages, and we've done several videos attesting to that.
You got it.
But this is a more efficient way for him to collect compensation.
So
and in the long term, for his heirs and his family, it's unbelievable.
So the premium, so for him, I think what they say, they were doing $5 million in premium plus another $2 million for 5 years. Right, so what would that be? That would be 10. That would be a total of 15. Yeah, 15 million in premium. So that 15 million in premium coming into this life insurance policy is going to get broken down in two different ways. And Jimmy, you mentioned it. Most people, when they buy life insurance, they buy it in such a way that the only thing they get is a death benefits. And insurance companies, they're good at what they do because they know when you're going to die, right? And so when Jim Harbaugh got this policy, they did extensive underwriting on him to find out, okay, how healthy is Jim and what's the likelihood he's going to pass away in a given period of time. But in addition to the death benefit, as you mentioned, it's really a cash value play, right? And a life insurance policy, when it builds cash value, you get some very unique benefits, right? You get number one, a guaranteed rate of return plus a dividend. Your money is 100% safe. There's a lot of people worried about the stock market right now, so the life insurance company will literally guarantee your growth. It's not tied to the stock market. But this
Harbaugh doesn't want to be playing the market to maximize his returns. He wants to be coaching football.
You got it. This right here is the thing right here. So tax-free. If you think of all of the places you can put your money today, most instruments, most vehicles in which you can put your money are either taxable, right? You pay taxes as you go, or you defer your taxes to a future date. Real estate is, gives you tax advantages, but there are still taxes associated with that. Life insurance is one of only 3 remaining places where you can literally put your money and have it grow tax-free. So tax-free, and then your cash value, this is the fun part, right? Your cash value is liquid, and most people will use their policy in 2 ways. They'll start off taking loans, which we're going to talk about what Jim's doing, and then at some future points, they will take distributions, which is income, but all of which is coming back tax-free, and this is all independent of the death benefit, right? Regardless of, whenever Jim passes away, the death benefit will pay out, but while he's alive, he gets to use all of these benefits.
Right. I mean, the death benefit's great, but this deal is so sweet without the death benefit. Because net, however he decides to spend his money, he's going to spend it the same way, whether taking a policy loan or if he took it as salary. The only difference is he has a lot more of it.
You got it. So they built in, it looks like, a clause on this that protects the university. So coming back to the University of Michigan, why would they give Jim Harbaugh a $15 million loan to fund a life insurance policy? That's because they know one day Jim's going to die. Whether that happens tomorrow or 35 years from now, one day he will pass away. And
every year he doesn't pass away, they collect more interest.
You got it. And that's exactly how they're doing. They probably took a loan and they amortized it over 10, 15, 20, 30 years. It doesn't matter. They just continually amortize it. And whenever he passes away, the loan plus the associated interest is due. But how does that loan get paid out to, and all of the subsequent growth, how does it get paid out to the University of Michigan?
Tax-free.
Tax-free. So this is an investment.
What do schools have, like Harvard? What is that called?
Their endowment fund? Yeah.
So this money's sitting in the endowment anyway, and they're looking for guaranteed rates of return.
Yep.
And so how magical that they can compensate an employee and then get a guaranteed rate of return off how they compensated their employee.
Yep. And regardless, it's actually a sweeter deal. The longer Jim lives, the more money they're going to get back tax-free. That $15 million is going to grow every single year, and at some future point when Jim passes away, the amortization of that loan will be paid out tax-free to the University of Michigan. So this is an investment, a guaranteed collateralized investment for Michigan.
Start the webinar with, do as I
say, not as I do.
Right, because Ann Arbor is a hotbed for pro-social policies, tax people so we can pay for our ivory tower social programs.
You got it. Now here's the
I love it. They're fine with everybody else getting taxed, but they're going to do everything they can to avoid it. That's awesome.
So now let's look at Harbaugh. Harbaugh is allowed to borrow against the policy while he is living, but he has to keep at least 150% of the premium value untouched. And so the reason he has to keep this untouched is he's got to protect the associated death benefits with that's going to pay out the University of Michigan. He's got to keep that protected for the University of Michigan. But the rest of the cash value that's in the policy, Jim Harbaugh now gets an opportunity to grow his money and use the capital at the same time. So Jimmy, tell us a little bit about what you're doing with your policy and how can you grow your capital and use it at the same time?
Go find another investment. Find a piece of real estate. Find anything that you think has a good chance of a return.
You got it.
You're also getting your return from your life insurance.
So when you take a loan from the insurance company, you've already taken a couple loans against your policy. Did they ever ask you what you're doing, why you're taking a loan?
Nope.
How you're paying it back?
Awesome.
Right?
Nope.
You're in control of it, and the reason for that, again, it comes back to the death benefit. They use your death benefit as collateral because they know if you pass away, they owe you money anyway, so they'll pay out they'll pay out the death benefit minus the outstanding loan. So Jim now gets a way to receive compensation tax advantage. He's probably getting taxed, on that $15 million, not as ordinary income, but he's getting taxed in some type of a bonus rate. So it's going to cut his tax bill in half. He's then going to take that money, put it into a life insurance policy, grow it tax-free, have the ability to utilize that capital for whatever he wants while he's alive, whether it's a loan or a distribution. It protects the University of Michigan, and whatever's left over in the death benefit will pay out to his family, his heirs, his estate. So it's a win-win all the
And he
way
can
around.
probably take a policy loan to pay his tax liability on this deal.
You got it. And that's probably it 100%, man. And this is probably a zero out-of-pocket money for him, but it's a way to beat the tax code, have liquidity, have control, and get compensated at a higher amount with a lower tax liability. And it protects the University of Michigan.
So 150% of the premium value untouched. If he puts $10 million into this and his cash value is $20 million, he can only pull policy loans off $5 million of that. Is that what that means?
Yeah, the difference between what goes in and what's available.
Okay, so it's going to take a little time for that cash value to grow up.
Yep,
or grow.
It'll take a little time for that, yeah.
And that incentivizes him to be a great Michigan coach to keep this thing going.
No doubt. And then
and where is in the article what his family gets?
Oh, yeah.
Let's talk about that real quick.
Yeah. Let's see, where is that down here? As long as the insurance policy stays active, Harbaugh does not need to repay the loan until he dies, because, again, the death benefit will cover it, so he gets to use the money without ever having to repay it. Can recoup its original investment, and the rest of the insurance payout would go to whomever Harbaugh chooses as his beneficiary. So whatever's left over, and this is why what we'll do, we'll go through a case study, and we'll show the total amount of death benefit, what goes to the University of Michigan, what pays out to his family. And the longer Jim lives, the better investment this is, both for the University of Michigan and as well as Jim and his family, because everyone wins in this example. Everyone, with the exception of the government, who just lost millions of dollars in tax revenue.
But then how will the University of Michigan pay for all the social programs they want to inspire?
Do what I say, not what I do. Let's win football games and get the right people in, getting compensated the right way, and then everyone else can pay the taxes.
That is awesome. These people, they're great.
Okay.
All right, well, we just wanted to do a quick video, just bringing people's attention to this concept, and thanks for watching. Okay, welcome back, Joint Ops fans. Jimmy Vreeland with Joint Ops Properties and Ryan Lee with Atlas Wealth, coming back to finish up our Jim Harbaugh case study. We got such positive feedback when we put the video out the first time, probably because I put it out on a Football Friday, but it seemed to get a lot of views, so we're going to go through the X's and O's of the policy. And you might be asking yourself, this is a real estate YouTube channel, why do I keep seeing life insurance videos? And the reason you keep seeing life insurance videos is we're just trying to make the point that if you are going to invest in real estate, you do want to start with a whole life policy first to maximize your return and use a better banking system.
Okay,
let's get it started, Ryan.
Cool. All right, so we're going to go.
And also, it's my YouTube channel, so I get to talk about whatever I want to.
That's the good thing about having your own YouTube channel, right?
Right.
So let's talk about Jim Harbaugh's policy specifically, and then we'll go in and we'll look at the numbers. Now, how they designed Jim Harbaugh's policy is anyone's guess. I kind of took a stab at it just so we can see why Jim Harbaugh and the University of Michigan would do something like this.
This is how you would have designed it.
Yeah. Yes. So Jim, he was getting $4 million up front, right?
And while you're watching this, in the back of your mind, be thinking, why wouldn't he just take this money as W-2 income?
Yeah. Well, that's a good point right there. I mean, let's just blow that apart really quick. So we're going to pull up a calculator here. This is Truth Concepts. This is a fantastic calculator to find the truth of anything out there. So all I'm going to do, I'm going to pull up, this is how our U.S. tax system works, right? So I think Jim's married, right? So let's say, what do we say, $4 million? Let's say he's getting $4 million. The way the tax code works is we get taxed on the highest dollar that we earn. In fact, let's take it a little bit lower just for the discussion here. If you're earning $20,000, the first $18,000 that you make, you're taxed at 10%. The next $55,000 that you make, you're taxed at 15%. The next $75,000 that you make, you're taxed at 25%. The next $51,000 you make, you're taxed at 28%, and it just simply progresses up and up from there. Today, the highest tax bracket you can be in, and this is just federal, this does not include state, but you can pay up to 39.6% in taxes. So if we think about this from Jim's standpoint, we need to add another zero on here. Jim's making $2 million, or what do we say, $4 million. Well, we'll just keep it $2 million for this. 1.5 million of the two will be taxed at 40%, meaning his total tax bill in this whole situation, $738,000 of 2 million is taxable. Gone, right off the top.
Right.
So,
do you think that's enough of his fair share?
Yeah, we'll see, huh? And it depends on who you ask if you watched the debates last night.
Yeah.
So, the way his policy was said to be designed is they were going to put $4 million towards the policy up front. And then after that, they were going to do $2 million a year for 5 years. So again, all we want to do is we want to figure out the right number, and we want to make this number the ideal number to keep our cost of insurance as low as possible. So with the policy,
And what would have been the tax liability on those dollars?
That would have been crazy. I mean, I guess if we just go back to this, 738,000, and this is assuming no tax deductions. I'm sure there's other ways that they could pay this out, but 738,000 times 7 of these. Is that right? Yeah, 5 million. So 5 million of the 14 will be taxable.
And what's the total percentage of? That's close to a third, right?
Yeah, easily.
Okay, so by doing these policy, he just keeps $5 million.
And more important, not more importantly, but just as importantly is that because it's life insurance, think about this. If we look at the tax code, there's really only 2 places that most people think of where to put our money. So let's just think of the tax code as a bucket system. Right? You can put your money in the taxable bucket, which means you pay taxes on that money as it's earned today. So think about if you have any money in a brokerage account, a CD or anything like that, every year you get a statement to say, hey, you earned X amount of dollars, and you have to pay a percentage of that in taxes.
Okay.
You can put your money in a tax-deferred account, and this is what most people choose to do for retirement. They say, okay, I'm going to put money in. Your CPA, who you hire to save you taxes today, says it's a good thing to do because he can come back and say, look, you earned X amount of dollars, you put in $20K into the tax-deferred bucket, and you get to take a deduction on that. But now what we're doing is we're taking this entire $20K and all of the interest that you earn on it.
This wouldn't work for Harbaugh because there's limits to how much you can defer.
Yeah, limits to how much you can defer. But even for the average person, the average person, a high income earner, if we think about the purpose of saving, the purpose for all fundamental saving is one day we want to turn it into a stream of income. Why on earth would we shift our biggest liability, taxes, to the future when we need the income the most? So the last bucket.
Hopefully you're wealthier when you're older.
You got it. Well, if you've got a CPA who's telling you that you're going to retire poorer than you are now, then you should fire him and get the right CPA. Right?
You sign up with Atlas Wealth.
You got it, Atlas Wealth, man. If your CPA tells you you're going to retire in a lower tax bracket, all he really is telling you is you're going to retire poorer than you are today.
And that's to me, that's always been a depressing image.
That is, man. What's retirement all about? It's not about living on top ramen. It's about traveling, seeing your grandkids, golfing, doing all the things that you might not have done during your working years.
Right.
But here's the interesting thing. If we look at the tax-free buckets, there are literally only 3 things that fit in the tax-free bucket. If you truly want tax-free growth on your money, you can use municipal bonds, right? Munis. You can use a Roth IRA, which isn't really available to high-income earners. But these are really controlled by the government, right? Municipal bonds are government bonds. Roth IRA is a qualified plan. The third option, and the only option where you have unlimited opportunity, is life insurance. So that's why if we look at large corporations, if we look at higher income earning executives like Jim Harbaugh, why on earth are they using life insurance? They're playing the tax game. They're using the tools, they're using the tax code as a way to show them what to do to get maximum efficiency of their dollars. Okay, so here, let's go to the numbers and let's look at how this thing would turn out. So I Googled Jim Harbaugh's age. Jim Harbaugh's 52. So I set up a policy on Jim Harbaugh here. He looks like he's in pretty good shape. He's a football player, and every time you see him out, before the football games, he's out pounding his quarterback and, yelling at him and running up and down the sideline. So I'm going to assume he's in preferred health. All that means is we're going to get the associated death benefit that we need for cheaper dollars. If he's in less than ideal health, then it costs a little bit more to get the death benefit. So Remember, we're going to get $4 million in within 6 months. So these first 2 premiums are from the $4 million. And then these last 5 premiums are the $2 million that the University of Michigan will put in every year thereafter. Okay? So a total of $14 million going into this policy. And what you'll notice here, this is kind of the cool thing, he puts in $2 million, and right away he has $1.5 million in cash value. $1.5 million in cash value. Now, there's some restrictions in this cash value. In this case, the way it's set up, the University of Michigan is kind of collateralizing that cash value, just in case he quits or his contract is terminated. So he can't technically use that. But Jimmy, what did you do with your policy the second you had it set up?
Pulled the money out and bought a house.
Bingo. So for the
technically, there's still $1.5 million on his balance sheet.
Yeah.
So he was a real estate investor. He could go to a bank and use that $1.5 million as collateral.
You got it. You got it. So we won't go into all the things you can do with this, but yeah, man, he could use this for real estate. He could use this to fund a business. He could use it to fund family travel, buy a second home, whatever he wants to use it for. This money is also earning an interest rate and a dividend, so effectively this is doing 2 things at the same time. We're not going to go into the mechanics of policy loans, but you can quite literally have your money doing 2 things at the same time. Now, it's easy to see there's a cost of insurance. $2 million goes in, 1.5 comes out. If Jim Harbaugh were to get hit by a bus tomorrow, the University of Michigan and his family would receive, however they split up the death benefit, they would have a $39 million death benefits. Now, looking at it from the surface, we might be thinking, man, that's crazy. That's a lot of death benefit for the cash value. Well, look at this big picture. This is the minimum amount of death benefit we need for the way this policy is designed, big picture. So we'll come back to how the cash value is.
And it would not be tax-free.
Yeah, you got it. Okay,
so when I buy my policies, the death benefits are great, and it is an added peace of mind, but I'm really buying them for the banking system that I can use. I want to get into that tax-free banking system, just like the banks are, just like high net worth individuals are.
You got it. So that's the whole goal. I mean, your policy has to be designed to do that. And here's how we start to see the design coming through. In year 2, with the second premium, so again, $4 million going in. So 6 months from now, the second $2 million goes into the policy, and the cash value goes from 1.5 to 3.3. So at this time, it jumps up by $1.8 million. So the majority of what just went into the policy now shows up in cash value.
So it's a $200K cost of insurance, year 2.
You got it. And this is the cool part. When a policy is designed this way, it's usually the third premium is kind of our magic year. So in year 3, with premium 3, when $2 million goes into the policy, cash value goes from 3.3 to 5.4. And what we can see right there is everything, his cash value just went up by 2.1 million. So now he's got a life insurance policy. He literally has a bank where every new dollar that's going into the policy is immediately being reflected in cash value, and he still has the $39.9 million death benefit.
And he's still collecting a dividend off all those dollars in the cash value.
You got it.
Tax free.
So in the 5th premium, right, they would have put in $10 million total into this policy. He now has $10 million of cash value. So from a cash value standpoint, he's break even, right? They've put in 10, they have 10 million in cash value, but they also have a $40 million death benefits. So in this example, we got 2 more premiums being funded, and then what we do is we actually close the policy. So by
year 7, that's $1.5 million in dividends and interest.
You got it. Yeah, you got it. And that's the cool part. I mean, a lot of people think about, man, if I open up a whole life policy, I got to put money into it for the rest of my life. And you can do that, and there's very good benefits for doing that. But after the 7th premium, we close this policy, which means nothing ever has to go into the policy again. And you'll notice what happens is when we close it, the death benefit takes a slight hit. We're not going to go into all the mechanics of why that is, but the death benefit drops from 43 million down to 34 million. So that 34 million is literally a paid up, completely funded death benefit. He never has to put another dollar into the policy to get that death benefit, but as you mentioned, Jimmy, he's got $16 million of cash value now. And that cash value continues to grow every single year.
It looks like he gets about $1.5 million dividends and interest every year, tax-free.
You got it. Now, the article wasn't specific about, was University of Michigan charging an interest rate on this loan, and if they were charging an interest rate, who was paying for that and all of that. So just to keep the analogy simple, University of Michigan loaned or gave Jim Harbaugh $14 million, and they're using it to fund a life insurance policy. So what I'm going to show doing is...
This is a guaranteed annuity for them as well.
Bingo. They know they're getting their money back. Whether Jim dies or he doesn't die and he lives, they've got enough in the cash value or they have enough in the death benefit. It's guaranteed 100% backed. Let's go up here to the top really quick. Backed by a company who has done this every single year since 1847 all the way to today. Never failed on a contract.
But imagine if they had just paid that in salary to Harbaugh too. They would have lost all that money.
Yeah.
And a good third of it would have gone to the government, so neither party would have benefited.
Yep, neither party wins there. So in this example, I'm going to show in year 15, and again, the exact mechanics, but just so you can see how this one works. In year 14, I'm going to show us taking a distribution, so taking $14 million back. So the original 14 that went in, we're pulling it back out. So you'll notice the cash value drops from 23 down to $10 million. The death benefit drops from 42 down to 17. So now the University of Michigan has all of the money that they put in.
He's not going to pay taxes on that $14 million still, right?
Zero taxes.
Nice.
But now the University of Michigan, they got the services that they wanted from Jim Harbaugh. So they're exchanging money for services. So they got their man, they got their services. What are they ranked right now? Number 4 in the country. They're getting a return on their investment. They get all their money back, right? Guaranteed. So it's protected, guaranteed. But what does Jim Harbaugh get out of this whole thing? Jim Harbaugh now at age 67, he's got $10 million of cash value. Now remember, that $10 million, this is tax-free. He's put it in the tax-free bucket. So that $10 million is his to use 100%, and he has a paid-up death benefit of $17 million. So there's a whole bunch of different ideas we could go into here. But man...
Right, contractually, he doesn't have to give that money back.
No, that's the way they put in the article. He doesn't... Because... The University of Michigan knows they're going to get the money back anyway. I could have put up another illustration and say, what if we took Jim Harbaugh to life expectancy? At life expectancy, the death benefit's going to be whatever, astronomical. And when Jim dies, they could say, okay, that death benefit plus the associated interest rate with the money we put in, we're going to take that. Jim, you and your family get the rest.
Pretty nice.
Pretty cool, huh? So, man, and that's...
What if there was a massive revolt of all employees wanting to be being paid this way?
Well, what's the book Carlos Lara wrote? What is that book where they talk about the 10% rule? To top the fractional reserve system, the banking system, it would take 10% of the population to start acting this way. So,
right,
man, it would crumble the system that's really designed to enslave the average American, right? The banking system enslaves us. It literally enslaves us.
If every Michigan fan started getting paid this way, there's your 10% right there.
Yeah. Yep. So, as a plug to Nelson Nash, if anyone watching this wants more information, read Nelson Nash's book. I think that's the first book you guys read when you first learned about this. He calls this strategy infinite banking concept. And it's quite simple, man. Once you understand the principles of banking and you understand some basic personal economics, the practical use of this strategy is infinite. I mean, Jim could use this for anything under the sun. You're using it for real estate. I've used it for real estate, for starting a business. Man, I paid for a heart surgery, an unexpected emergency heart surgery using my policy one time. It's a reservoir of capital that you control that is outside of the government's hands. It's a private contract between you, a private individual, and a private insurance company. It's quite literally an infinite opportunity possibility.
Right. It is. What banks are supposed to do is be a safe place to store your capital. Because of bail-ins, because of a lot of other reasons, they don't do that anymore. So this is going to have to take over the banking function for average Americans. So when I look at it, the death benefit's great. I just have a better banking system now.
It's one that you control. When you took your policy loan, did the insurance company ask you any questions at all?
Nope.
Did it affect your debt-to-income ratio when you went down to the bank and tried to get a typical loan?
Nope. And it's still on my balance sheet as liquid cash.
You got it. It's a pretty amazing concept, man.
I love it. That's why we keep doing these videos. even though this is a real estate YouTube channel. All right, well, if this doesn't convince you it's a better banking system, and go out to your boss tomorrow and ask to get paid this way. And talk to you later. Bye.
See you guys.